Hey, welcome to The Explainer. Today we are diving into a huge, kind of unspoken tension right at the heart of decentralized finance. It's this hidden battle that pits the promise of massive returns against, well, the simple need to survive.
So, how did we even get here? Before we can really dig into the risk, we have to talk about the reward. That powerful allure that pulled millions of us into DeFi in the first place.
Yep, that's it. That one word was the magic key. DeFi just exploded onto the scene because it promised these incredible high-yield returns, real passive income, and something totally revolutionary. You had full control over your own assets. It was a potent mix, and for a while there, a very profitable one. But behind all that excitement, watching the numbers just go up and up, there was this critical question that most people just kind of ignored. What happens when the party's over? When the market takes a serious nosedive, is this whole system actually built to handle that pressure? Or is it all just a house of cards waiting for a gust of wind? And listen, this isn't just some what-if scenario. Researchers have actually modeled this exact situation, and, well, the results show a pretty startling fragility in some of these systems. It really does feel like a ticking clock.
So back in 2020, a research team decided to put this to the test. They built a model of a DeFi lending protocol with a pretty significant chunk of change locked in it. We're talking $400 million. This wasn't some tiny experiment. It was a system at a scale we see every single day in DeFi. And their conclusion? It was absolutely staggering. They found that during a major liquidity crisis, a market crash where basically everyone is sprinting for the exits at the same time, a system of that size could totally collapse. Not in a few months, not even in a few weeks, in just 19 days.
Okay, so why? Why is the system potentially so fragile? Well, the risk really comes from this fundamental conflict. It's a battle between two opposing forces that every single protocol has to try and balance.
The easiest way to think about it is like a race car. Capital efficiency, that's your accelerator, slammed to the floor. It's the engine that's generating all that incredible yield, making sure every single dollar's out there working, not just sitting around. But solvency, that's the brakes. That's your safety system, the reserves you keep on hand to make sure you can actually survive a sharp turn or, an unexpected crash. You absolutely need the accelerator to win the race, but without the brakes, you're just heading straight for a wall.
To put it as simply as possible, solvency isn't just about having money. It's about having enough in the tank to meet all your promises, even when the market is going completely haywire. And in a world as volatile as crypto, solvency isn't just some nice feature to have, it is the ultimate measure of survival. Period.
Now, the good news is the industry is very aware of this ticking clock. So let's take a look at how different projects and even governments are trying to install some better brakes on these super high-speed systems.
The industry is really tackling this from all sides. You've got giants like Aave building dynamic risk tiers to adjust how much exposure they have based on what the market's doing. Others are creating these super sophisticated risk oracles to basically price danger in real time. Then you have some bringing in real-world assets to diversify away from crypto's wild swings, while others are focusing on smarter liquidation models to protect users during a crash. Each one is a different shot at solving a piece of this big, complex puzzle.
And it's not just the developers, right? Governments are now stepping in. We're seeing these landmark bills on the horizon for 2025 in the US, like the Genius Act, which would force stablecoins to have one-to-one reserve backing, and the Clarity Act to finally sort out who's in charge of what. Meanwhile, over in Europe, they're looking at how to apply their own traditional finance safety rules called Solvency I to the world of crypto. The push for safety is definitely coming from all directions.
So while a lot of projects are trying to patch the system after the fact, some are asking a much bigger question. What if you just designed for durability from day one? Let's zoom in on one example of that philosophy in action.
So this approach, from a protocol called Elevra, is all about building solvency right into the DNA of the system. It uses things like tiered capital pools to spread risk around, it gives you real-time dashboards so you can literally see the reserves, and it hardwires proof of reserve logic right into the system. It's a design philosophy that consciously puts safety on the exact same level as yield.
All right, so we've looked at the promise, the peril, and the hunt for solutions. And all of this brings us to the final, and I think most crucial takeaway for anyone who's active in this space.
This quote really just gets to the absolute heart of it. Think about it. In a bull market, when prices are only going one way up, generating yield is the easy part. Everybody looks like a genius. But that is not the true test of a protocol's strength.
So that leaves us with the one question you should be asking of any project you're involved with. Just for a second, forget the flashy APY. The real test, the real question is when the inevitable downturn happens, is this system built to survive it? Because at the end of the day, that is the only yield that actually matters.